Hey guys, JC Parets here of allstarcharts.com and welcome to the show. Shout out StockCharts TV for having me on. So just to reiterate a couple of things that we like to do here. Number one, we want to have a lesson, right? Because let's say my charts are terrible. Let's say I do a terrible job of explaining what's going on in the market. At the very least, there's a good lesson out of it, right? And then let's dive into the markets, right? What are the charts suggesting? What are they pointing to? What are the big trends that we want to be acknowledging right now? And which ones do we want to be avoiding, right? This is clearly not the same market environment that we had in 2020. In case you hadn't realized it yet, it's very different. And we're going to talk about that. And then finally, we got to take some questions, right? Fire them over, keep sending them over, info@allstarcharts.com, keep sending them over, and we'll do our best to answer all of those and address them here. So with that being said, let's talk about the lesson of the day. And I think the lesson of the day is really to not put too much weight on any one indicator, right? Or any one data point. People are like, well, JC, what is your favorite technical indicator? And the answer is price. That is the number one technical indicator. Everything else is a far, far second. Volume or your whatever oscillator you use or whatever indicator you built in your mama's basement or whatever. Just kidding. Not really though. Right? You know what I'm saying? All of these things are a far second. We all know those oscillator junkies that it's like there's so many lines and colors in the chart. It's like, which one is price? You know, I've certainly seen plenty of those. So don't be that guy. Don't be the oscillator junkie, right? Keep it simple, stupid, right? Price is the number one technical indicator. Now, with that being said, we have so many other things that we look at that are a derivative of price, like relative strength, momentum. All of those are derivatives of price, just to be clear. All of the intermarket relationships, the breadth work that we do, all of that combined is what we like to say it's the weight of the evidence. So we want to weigh all of the evidence. There's a great portfolio manager from Wellington, Mark Teixeira. He used to say, on one, we weigh the evidence and you make two piles, right? So this is a bullish pile, this is a bearish pile. You keep piling them up. And it's like, well, on one hand, you've got this and this and this. Frank Teixeira, sorry. Mark Teixeira was a baseball player. Frank Teixeira, sorry. And on the other hand, you've got this and this and this and this, right? And then whatever pile is bigger, you lean toward in that direction. You start to notice over time that these piles are constantly getting bigger and smaller, and different data points are going back and forth between them. So when it comes to, JC, did you see this divergence in small caps or whatever? That's one data point. It's one thing of a million that we look at. And we started to see deterioration and on that. So that's the lesson. And then before we get into the charts, to sort of rewind a little bit, you started to see deterioration in March. I remember specifically being like, hey, everything's bullish, new highs, all these things, but these consumer staples bottoming out on a relative basis, that doesn't make sense with all that other stuff going on, right? So it was like one thing, so fine. And then small caps later on in March broke back below those February highs, which was a big problem. So now price is confirming what staples had already been pointing to. And then, NASDAQ and growth had already been rolling over for a while. The constant deterioration in small caps, and now you're still seeing that relative strength out of the defensive areas. Why do the bonds keep going up in price? Why? Gold keeps doing so well. European credit spreads are starting to widen. Why are all those things happening, right? There's intelligence in credit. So anyway, that's the lesson. Weigh all the evidence. Don't look at just one indicator or one data point. That would just be silly. So what are we noticing, folks? What are we noticing? We are noticing that markets are a mess, right? Chop, 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 chop. Markets are a mess. Not anything that should be unexpected. In fact, I just want to reiterate that if we weren't in a choppy market environment, that would be incredibly unusual. That's what would be strange. The fact that we've been in a choppy market is actually perfectly normal. I'll bring back this chart that I showed last quarter, and then you got the monster ripper off the 09 lows. And then what happened in 2010? Chop, 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 chop. Then after the tech bubble burst in 2000, markets crashed, right? Big bottoming process. What was that final pivot low in 2003? Monster thrust higher. And then what happened in 2004, which was year two? Chop, chop, chop. You saw it in 83 after a monster ripper. What happened in 84? Chop, chop, chop. Off the 1974 low and the monster 1975 epic year. What happened in 76? Chop, 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 right? So what have we been seeing after the epic rally in 2020. What have we seen after that year was over? In year two, we're seeing a choppy mess, right? So why should this be unusual? I love pointing out the market sentiment. This was a classic New Yorker magazine cover at the end of March of last year. The week that stocks bottomed, they were the most pessimistic I've ever seen, or one of the more pessimistic times I've ever seen, I should say. And what did these brilliant journalists come out with last week? The most optimistic cover yet. Look at this, a lovely, beautiful family, finally able to leave their house and enter the big city for the first time. I mean, just a beautiful, lovely story. I say you short the hell out of it. And then let's remember what happened a year ago. I mean, The Economist, classic. The week the stock market bottomed, this was The Economist magazine. I mean, they don't get more bearish. You can't get a more pessimistic magazine cover than the earth being closed. I mean, hello. That's the week stock market bottomed and proceeded to go on the best rally for stocks in over 75 years. And then let's, of course, classic The Economist, the best. The week stocks peaked. They came out with their brilliant cover of Stampeding Robot Bulls. I mean, man, does it get more? Does it get better than that? Needless to say, we were already shorting tech by the time this cover came out, so it was pretty funny to add on to that. And then just while we're on the subject, let's just bring up one of my all-time favorites. I actually have this one framed in my desk, not on my desk, in my office. And you know, there's an old saying amongst the old school technicians. They'll tell you that if there's ever a chart on the magazine, you buy it. You buy stocks all in. So this was after the tech bubble burst in 2000. You know, the stocks went. This was literally the week that the stock market bottomed after one of the biggest collapses in history. The New Yorker nailed the bottom, just classic. So whenever you see a chart on the cover, you buy it. That's what the old timers will tell you. All right, so that was a little fun with that, and just to remind everybody what things looked like at the bottom and what the magazine covers look like now. I would argue a little too optimistic. A little too cute of a story for me. We're shorting it. All right. So why have we been shorting stocks? Why have we been raising cash? Why have we preferred to be in bonds and in gold and in other areas? Simply because those are the ones that have been working. Notice what happened over the last year. Bonds were the worst place to be in the world. Bonds stopped going down, right? Bonds stopped going down, and they haven't been going down for 2 months now. Same thing with gold. If you notice, gold keeps making new highs. That trade keeps working for us. We'll take it. One for the good guys. Japanese yen as well stopped going down. This is the consumer staples bottomed on March the 1st, as we mentioned earlier. Utilities bottomed on March the 1st too. Are these, this is on a relative basis. So are these the leaders that you should expect to see in a strong bull market? Or are these areas that should be outperforming in an environment that stocks are under pressure? Messy at best. Selling off at worst, right? Either way, not environments where we want to own stocks, right? And then meanwhile, the Dow Jones Industrial Average just hit our upside objective, right? So sure, we have longer term targets up near 38,000, but this is a perfectly logical place for stocks to stop going up. The 261.8% extension of that entire 2018 decline, right? It stopped on the way up and then crashed from there. Finally broke out above that. Here's your next extension. And meanwhile, the transports are doing the same thing. Right? Stopped where they needed to stop the first time, sold off, came back, just achieved its next target. I think that Dow Jones Transportation Average was up 14 consecutive weeks. 2 weeks ago, we got the first down week since January for transports. So it's not, it wouldn't be unusual at all for stocks to continue to correct, particularly as they achieve these levels. By the way, if you're interested in these slides, just go ahead and email info@allstarcharts.com. We'll send you the entire slide deck for today's show. Make sure to use the password bullish fiat. That is the password. If you don't use the password, we're going to send you some other deck from some other presentation I gave this week in Taiwan or something. So bullish fiat. Make sure to use the password bullish fiat, and I'll send you the whole slide deck, or Peter will anyway. All right. Meanwhile, the Dow Jones Industrial Average and Dow Transports, the two most important indexes in the world, as far as I'm concerned, both achieving their targets. And then what do you know? The third most important stock market index in the world, which I consider to be the German DAX, is also hitting its upside objective, the 161.8% extension of those 2018 to 2019 declines, right? Or end of I guess it bottomed December 28th of 2018, so the 2018 decline. So, all right, so what else is happening? So staples are not just outperforming the S&P 500, but they're also outperforming consumer discretionaries. They're outperforming consumer staples. They're outperforming communications, right? These are all things that we have not seen in a long, long, long time. Notice how these lines used to go up, right? These lines used to go up, and now they don't. So that's something interesting. What about credit spreads? Let's look at junk bonds versus U.S. Treasury bonds. Also lines that we are accustomed to seeing go up to the upper right of the chart. And they are not with the S&P 500 making new highs, lower highs in junk versus treasuries. And I didn't bring the European yield, the yield spreads, credit spreads in on here. But if you go look at France, Germany, you look at Spain, Germany, Italy, Germany, they're all telling you the same thing, right? They're actually telling you more obnoxiously than here, especially the France, Germany spreads. Check those out. Those are unusually large. And you could be like, well, that's because of the German Bund of what it's doing. Fine, I don't care why it's doing it. I'm telling you what's going on over there, and credit spreads are blowing out for the first time in a year. Blowing out might be a little dramatic, but they're widening for sure at the same time that you're seeing these divergences in U.S. credit. Meanwhile, it was a beta chase for sure off the lows in 2000, and now you're seeing lower highs and high beta versus low volatility while you're seeing new highs in the S&P 500. So, getting back to my earlier point about weighing the evidence, it's not like it's one data point. It's not like it's one chart that's saying, hey, heavy cash positions. That's why the password is bullish fiat, because we really, really like heavy cash positions. And then look at, let's go underneath the surface. Where's the weakness? It's in the NASDAQ. Notice how the list of new lows in the NASDAQ keeps getting longer, not shorter, but you're not seeing that in New York Stock Exchange Composite, which is much more value-oriented. At least you're not seeing it yet. And then here's the expansion of the new 21-day low. So even shorter-term indicators also, you're seeing a lot of action here that you're just not seeing on the New York. So big difference. Where else are you seeing it? You're seeing it in small caps. Right? Look at the percentage of new 21-day lows, new 63-day lows. These lists are getting longer, not shorter. So these are downside breadth expansion, not what you normally see when stocks are about to make a big move higher. It's what you normally see when stocks are about to make a move lower. Then meanwhile, when you look at the Russell 2000 itself, you have that bullish momentum divergence at the highs and now potentially putting in a pretty nasty top. Nasty top, right? You want to be long with this thing crashing? I sure as hell don't. Right? So if we're below 216, and only if we're below 216, do I like the Russell 2000 short? If we're not below 216, neutral or even long is fine with me. I don't have a problem with that. I'd rather be in cash and short a breakdown. But 216 is the level because you don't want to get caught in one of these, right? Ask anybody who's been caught in one of these. They suck. You don't want to be short when it's ripping in your face, right? This is not how to make money in the market. But shorting these is, and you tend to make it pretty quickly because it's, what do they say? Escalator up, elevator down. So I'd rather take the elevator down to 170 if you ask me. So anyway, these are the levels that we're watching. 216 for me, that's the big one. So you got the breadth deterioration, the setup, the top is there. If we break, there's your short. So you short a break. If we don't break, then the risk is still up. Right? So keep that in mind. So if we're holding 216 on the Russell and you're bullish stocks, go America, right? So then anyway, here's a closer look at the small caps, right? So this is what I meant in March. So, you got the signal in March, probably right around here. You're making new highs in small caps. You're like, hey, that's great. As long as we hold those February highs, everything's probably fine. And that the staples outperforming the last couple of weeks, and no big deal. It's just one data point, right? So that's the thought process right here. And then we broke. As soon as you broke, now that's where all the dead bodies are. That's where they're all buried. So, and any test back up to those levels, you're going to run into those dead bodies. And that's precisely what we saw, right? So as long as we're below that, there's really, for me, neutral at best and looking to short a breakdown. Maybe we don't break down, right? If we hold this 216 here, maybe we don't break down and everything's fine. Maybe. Why are those European credit spreads blowing out? Why are we seeing divergences in high beta and junk and staples discretionary and, so many divergences? Why are all those showing up at the same time that a lot of our upside objectives are getting hit in stocks? Why are all those things happening? In my experience, it's probably a good idea to be in cash in those positions. You guys are welcome to do whatever you'd like, right? Maybe you're this guy and you think Russells are going to rip. Good for you. And if you're in that and you got a good entry point, God bless you, right? It's not for me. I'm going to wait to short a break. I'm also noticing, everybody thinks inflation's here. Willie's newspaper, local newspaper in Milwaukee, was talking about the CPI data. It's the local paper in Milwaukee. The Barron's cover a couple of Saturdays ago with the giant eye, the inflation eye, like the eye is here. Like, if these journalists think that inflation's here, I recall a year ago when, the Economist was talking about the exact opposite. So it's funny the way the way sentiment shifts. So if everybody thinks inflation's here, the trade is, what if it's not? What if inflation is not here? What's the other side look like? Rates are probably falling, right? Bonds are probably doing well. To me, it seems like everybody thinks this 1.4 level is going to hold. And maybe it does. Maybe. But what if it doesn't? What if it doesn't and we lose 1.4? I think the small caps are going to have a say in the matter. Notice how close these two look. We're looking at the small caps versus large caps ratio and the U.S. 10-year yield overlaid. So what are we thinking here? If small caps continue to underperform and they really get slaughtered and we lose these former lows, what's that say about the 10-year? I think we're below 1.4. I think bonds are ripping. How are stocks doing in that environment? Probably not too well. And then here's your trade in bonds. I still like this one. So IEF 114, that's the level. I'll put here also see TLT because a lot of people like to use TLT as the vehicle, and I do too. It's more liquid, particularly in the option side. Across the board. But I like the IEF because this is more of the benchmark yield. And then also the risk reward is so clean, right? Former resistance from 2016 and 2019. We broke out last year. This is part of the reason we were so bullish of bonds at the end of January in 2020. Beautiful breakout, hit our upside objective, like literally kissed it and then backed off. I mean, you can't draw it up any cleaner than that. I guess if I was really smart, we would have shorted bonds. We were busy buying stocks, so that's fine. Similar trade. And now anyway, we're back to the scene of the crime, right? So 114 is the level. If we're above 114, I like bonds from the long side. And then it's funny because when you ask the bond market what they think about inflation, now that everybody and their brother is telling me inflation's here. In fact, my wife's cousin's husband was asking me about inflation the other day. He's a general contractor, plumber. I've never spoken to him about the stock market or economics in my life. It's usually about like pools and, construction and stuff like that, or maybe a four-wheeler or two is the extent of our conversations. And now he's asking me about inflation. Well, actually not even asking me, telling me about inflation. I'm like, oh yeah? All right. Anyway, so here we're looking at inflation-protected treasury securities relative to traditional non-inflation protected. And if there's ever a time that this is going to back off, wouldn't this be a perfectly logical place? Nice bearish momentum divergence, just like we've seen at prior peaks. If this were to come off, what does that say about yields? What does that say about inflation? I think it says that it's not here and yields are going lower. Meanwhile, look at the US, look at gold price in Australian dollar and the US 30-year bonds. They look exactly the same, don't they? Like seriously. So with gold price in Aussie breaking out, what does that say about bonds? I think higher. And then here's the US 5-year yield getting back to those former lows from 2016. So if the 5-year yield's ever going to back off, wouldn't this be a logical place for it to do it? Right? Former resistance turns into support, or its former support turns into resistance. Well, I guess it depends on how you look at it. This is former support turning into resistance, but if you ask the bond guys, they're real sticklers for the nomenclature. So this would be this would be resistance in bonds, and this would be support. So anyway, if you're one of these nomenclature sticklers, the bond police will come calling. But either way, you guys know what I mean. The classic polarity. Moving on to currencies, you can see really the strong negative correlation over time between commodities and the dollar. Commodities tend to do well as the dollar's falling. Commodities tend to be under pressure when the dollar's doing well, et cetera, et cetera. Dollar's gotten smoked over the last year and change, and commodities have ripped, right? Now, within commodities, you talk about gold has really been the only commodity that hasn't been participating in this rally. It's really the only one. And you know why? Because maybe it's not a commodity, it's more of a currency. Ever think of that? So I think a squeeze is coming here. I think it's certainly set up for it. This is gold relative to the rest of commodities. I think a squeeze is definitely underway. When you look at gold price in other currencies, when you look at the dollar, it's still below the 2011 highs. But when you price gold in euro, British pounds, yen, We're well above those levels. Well above those levels. Then when you look at gold price and all the currencies, we're above the 2011 highs on all of them except the dollar, right? Pretty much. So the gold miners trade's been working. You guys who've been following along, remember all this former resistance turning into support. You know, our bond trade is basically the same idea here, right? It hasn't worked out, it hasn't started working out as well as gold did, but it's the same entry point, same idea, right? All that former resistance turning into support. I think we get back up to the mid 40s, ultimately to 62 in GDX. But let's crawl before we walk here. Let's get to our first target first, reevaluate. My suspicion is it's going to be a little trouble. All that former support turned into resistance. I think that happens again, at least temporarily. So we'll reevaluate in the mid 40s. And don't these just look like nice little bottoms? Just nice little bases, right? Cute, pretty little bases, right? Things we haven't seen in gold and precious metals in quite some time. And then I like this one for execution purposes. 49 bucks is my level there. If we're above 49, let's go. Let's get it. With a target of 66, right? So I really like this a lot. Only if we're above 49. Below 49, leave it alone. Above 49, I like it, along with a target of 66. Because that would complete this entire base, cup, handle, whatever your nomenclature of choice might be. I look at this as a big base. We keep bumping up against these levels, and now we rip. I could totally see that. And if gold is ever going to start to outpace copper again, this would be a perfectly logical place. Let me take you back to the year of our Lord, 2017. You know, towards the end of that post-Trump election rally, one of the greatest years in stock market history. And at the time, for 1 ounce of gold, you could buy 389 ounces of copper, right? And that's when risk peaked all over the world. Most indexes around the globe started selling off, right? Risk really peaked in January of 2018. And then eventually, by the depths of the coronavirus crash last year, that same ounce of gold bought you 777 ounces of copper, right? Almost doubled, right? So anyway, over the last year, as stocks have ripped, there's less need for yellow rocks. There's just been no need to buy rocks, and instead they've been buying the copper, building stuff, all those things. And now here we are, back to the scene of the crime, right? So if copper's ever going to start to underperform, this would be a logical place for it to be. If gold's going to have its ripper of a moment and really get going, not just on an absolute basis, but relative, again, this would be where that would happen. You got a perfect little bullish momentum divergence at that former support. What else you want? It's all pointing to the same thing. Own gold, sell the base metals. And then when you look at the copper gold ratio, talk about a nasty failed breakout. Copper gold's been getting slaughtered. And as you know, it looks like, maybe you don't know, but just as a heads up, copper gold ratio in the US 10-year yield moved tick for tick. So with new highs in copper gold, you got lower highs in 10s, and you got a bearish momentum divergence on those new highs in copper gold ratio. To me, that screams lower for all three of these. So that means higher bonds, higher gold, right? Rates probably falling, copper falling. The opposite of the last year, basically, right? All right, let's get into some cryptos. Nice crash last week. Fell below our 47,000 level and hit our next level of 30. Like, you can't draw it up any cleaner. Right? Literally stopped going down where it should have, started crashing where it should have, completing that top. So anyway, you know, the Russell 2000 to me looks like Bitcoin at 47,000 ready to collapse down towards 170, 175 or so. So just something to keep in mind. Russell 2000 looks exactly like Bitcoin did. So now we're stuck in no man's land. So 30,000s are floor, 47s are ceiling. If we're in between that, there's really nothing to do. Nothing to do. It's a hot mess in between, and we're right smack dab in the middle of those. So nothing to do there in the Bitcoin. Curious to see how the how the changes in positioning in the futures market. As you can see here, the hedge funds were very short, and they've been covering on this decline. And the SPACs were super long and have been getting whacked, as you can see here. So you're getting that mean reversion in the positioning, which makes sense. And then in Ethereum, just saw the second biggest decline ever. One of the biggest declines we've ever seen in Ethereum. And last time we saw something like this, that was the bottom. Something to keep in mind. Doesn't mean that's what's going to happen this time. But 2250, that's been my level. You know, you can give it to 2000, give it more room. You know, pick your poison. It's totally up to you. I like 2250 personally. If we're above that, I like Ethereum long with a target back up towards 3,600. Notice how when it broke our 3,600 level, that's when things got nasty. Same way when Bitcoin broke 47, same idea. and then got support where it needed to. It wasn't clean. It wasn't as clean as Bitcoin, but managed to find support there where it needed to, when it needed to. So 2250, 2000 if you really want to give it room. For above that, I think it's fine with a target back up towards 36. And then the Ethereum Bitcoin backing off at a former level of resistance in 2018. Same thing with the Bitcoin dominance, right? The Bitcoin dominance is really driven a lot by Ethereum, even though some of the other coins are catching up. Again, logical areas, right? So really interesting there. And then talk about relative strength. When you look at all the cryptos, where's the relative strength? Notice how that polygon really stands out to the upper right. So on the y-axis, we're looking at the drawdown from all-time highs. Then on the x-axis down below, we're looking at the change since Ethereum's peak. I thought that was a good anchor point there. So needless to say, the further to the upper right it is, the stronger. The further to the lower left it is, the weaker. And Polygon just really, really stands out in terms of relative strength. So that's the manic, to be clear for those that are unaware. And by the way, if you're interested in these slides, again, email info@allstarcharts.com. Make sure to use the password bullishfiat. Password bullishfiat. Info@allstarcharts.com. So here's that Polygon now. Let me just punch up the latest data. Let's see. I got it right here. See where we're at as we're recording. We're about 217. So really in that no man's land area between the 169 and 274. So really stuck right in the middle of that range, as you can see here, right? Right in the middle of that range. Excuse me, guys. So what's really interesting here is the Cardano. This is Cardano relative to Bitcoin. The way I learned it is the bigger the base, the higher in space. It's really hard to ignore all of that relative strength, which is interesting. And then you got a nice risk reward. So right now we're right in no man's land, right around $1.70. I like it above 131 with a target of 211. And where are we? 170. We're right in the middle. So like Bitcoin, like Ethereum, like Manic, we're pretty much in no man's land right in the middle. So now zooming out, let's take a look at all the altcoins relative to Bitcoin. If the altcoins are going to start to outperform again, this would be a perfectly logical place for it to do that, right? Right at the former resistance on a relative basis. I like this potential squeeze in Algo. So this is Algorand. So take a look at this. If we're above $1, let's call it, let's see, to really be specific, 95 cents, that's really the level, 95 cents. If you want to call it $1, but really 95 cents, that's my level. If we're above that, I think the squeeze is on. I've seen these before. You got this consolidation trying to resolve lower, but it doesn't. Oops. And then you get the ripper. And if that is this, granted, you got a nickel of downside, so you're going to be wrong quickly. But if you're right, not only are we going to get back to the top of this, but in all likelihood exceed and head up towards 3. So you're looking at a 200% upside with a 5% downside or less, depending on when you get in. I don't care who you are. That's a pretty sweet risk reward. So that's how I look at that. So keep that in mind. Looking at the Binance, let me just pull that guy up. So let's see, we got the BNB. Because these things move, so I want to make sure that we're giving the right prices here. So yeah, 348, that's the level. We're above that. So we're looking at those former highs from earlier in the year. So we're looking at 330, 340, 345. The highs from, I'll tell you the exact date, was February the 19th. So those highs, that's the level. If we're above those highs, I think it's fine. I think you own it. If we're below those highs, then the risk is very much to the downside, and we want to be careful with that. So guys, that's all I got. If you want the slides, make sure to email info@allstarcharts.com, password bullishfiat. We didn't get to the questions, but we will next week, I promise. Send in the emails, info@allstarcharts.com, bullishfiat. Thanks, guys.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.